One stock just cracked today's top 5 for July 9th. AVGO, Broadcom, just moved into the spotlight on a strategic catalyst. Apple and Broadcom announced a $30 billion partnership to accelerate AI chip manufacturing on American soil. This isn't just corporate PR, it's a signal that chip design leadership is consolidating around companies that can control their supply chain and production. For a stock down 21% from its 52-week high, this manufacturing alliance could be the inflection point between pullback and recovery. We're watching AVGO because the broader market is repricing its role in the AI hardware race and the geopolitical shift toward domestic chip security. That sets up a potential recovery into resistance at $414 and beyond. Price is sitting at $388.69, up nearly 5% on above average volume today. That's not a breakout whisper, that's conviction. The stock is trading between its 50-day moving average at $406 and its 200-day at $360, which means it's in the middle of its intermediate trend. It's still down more than 20% from its peak, so this bounce has room to run if momentum holds. The next major level to clear is resistance at $414.64, which lines up exactly with the 50-day MA. RSI is at 50.25, that's the neutral zone, right in the middle between overbought and oversold, which means there's room for the stock to run before hitting exhaustion. The 50-day and 200-day averages are both trending higher, though the pace is slow. This is a stock that's recovering, not rocketing. The distance between support at $356 and resistance at $414 is roughly $60, which gives us a clear range to work with as the story develops. The Apple partnership is real and meaningful, but it's not a guarantee of immediate margin expansion. Broadcom still has to execute, secure supply chains, ramp production, hit cost targets, and deliver on time. These partnerships always sound better on the announcement day than they play out in practice. The geopolitical backdrop, domestic chip manufacturing is now a national security priority, works in AVGO favor long term, but competition from Intel, Samsung, and TSMC's own ambitions is real. The real risk is if the partnership becomes a commodity play rather than a differentiation tool. The put-to-call ratio is 0.368. That's very bullish positioning, meaning for every dollar bet on the stock falling, nearly $3 are betting it rises. This is smart money territory. Big players are willing to pay for upside calls because they believe the risk-reward favors higher prices. When puts are this cheap relative to calls, it usually means institutional money expects the stock to find a bottom and push higher. That alignment between technical recovery and options positioning is what makes this watch setup credible. We're rating this watch with an up direction and moderate conviction. That means this is not a screaming buy, but it's a stock worth monitoring for entry on any dips back into the $378 to $388 zone. Your stop is at $353.42. If the stock closes below that level, the recovery thesis breaks and you exit. Target 1 is $400. Target 2 is $414.64, where the 50-day moving average lives, and target 3 is $476. If momentum accelerates, with a $35 stop and potential $88 profit on the base case, the risk-reward structure supports taking this trade at scale. Broadcom is transitioning from correction to recovery on a genuine catalyst and smart money options positioning. The Apple partnership isn't a guarantee, but it's the kind of strategic bet that reshapes how the market values semiconductor exposure in this cycle. Watch for hold above $400 as confirmation that buyers are in control. If this breaks above the 50-day moving average and holds there, the structure suggests a sustained recovery mode. Until then, this is a watch and wait setup, not a chase.